Welcome to today's Skilled MBA Global Markets Insight. Our headline for this session is When Rate Cut Hopes Steady Asia. This topic explores how financial markets across Asia reacted to global interest rate expectations in November, an important case study for understanding volatility and central bank signaling. The report examines how hopes for interest rate cuts, particularly those expected from the Federal Reserve, helped stabilize Asian market sentiment after weeks of uncertainty and sell-offs. This case highlights how global financial expectations, even before any real policy decision, can significantly influence investor confidence, asset pricing, and cross-border capital flows. Published on November 28, 2025, this update provides timely insight into evolving macroeconomic conditions. November's market volatility offered a practical lesson in monetary policy's real-world effects. Students explored cross-asset correlations and market psychology, while faculty examined Federal Reserve transmission mechanisms. Industry stakeholders gained insights into risk management and policy-driven volatility, crucial for portfolio positioning. This case exemplifies the interconnectedness of global markets and the importance of understanding monetary dynamics. Asian markets found stability after significant volatility, with an 85% chance of a December Federal Reserve rate cut anticipated. This led to a boost in risky assets, stronger regional currencies, and moderated treasury yields. This scenario offers insights into monetary transmission, investor psychology, cross-asset correlations, and geopolitical linkages. November's turmoil was marked by tech valuation fears, triggering sell-offs in Japan, South Korea, and Hong Kong. Analysts cautioned about a mini-tech bubble. The 43-day United States government shutdown, the longest ever, obscured Federal Reserve policy paths. Bitcoin's 17% drop led to a collapse in risk appetite, while weak manufacturing in Europe and China, alongside geopolitical tensions, further slowed growth. Federal Reserve Governors Christopher Waller and John Williams endorsed a December rate cut, shifting market expectations from 30% to 85% probability in just a week. This restored confidence, leading to institutional capital inflows into Asian equities, bonds, and currencies. Lower rates are anticipated to expand liquidity, facilitating easier credit and economic stimulus. The Asia-Pacific markets are showing signs of recovery, with the MSCI Asia-Pacific ex-Japan Index up 3% after 4 weeks of losses. The Nikkei 225 gained 3.2%, signaling renewed optimism despite a 4.3% monthly decline. Kospi rose 2.5%, indicating restored stability even amid central bank caution and recent sharp sell-offs. Bond markets are signaling potential easing, with the 10-year yield holding at 4.094%, marking a 10 basis point monthly drop. This decline suggests rising bond prices and expectations of an accommodative Federal Reserve stance. Lower rates can reduce corporate borrowing costs and enhance global liquidity, often forecasting economic conditions ahead of equity markets. Currency markets indicate a risk-on sentiment, with the Australian dollar appreciating by 1.2% and the New Zealand dollar by 2%. These high-beta currencies gain as investors anticipate rate cuts, signaling a shift towards riskier assets. This appreciation reflects a broader confidence in economic recovery and potential end-to-easing cycles. Oil prices continue to decline, with Brent crude at $63.34 per barrel, driven by weak global demand, increased United States shale production, and geopolitical tensions easing. Meanwhile, gold sees a 4.6% monthly gain, reflecting its role as a hedge against macroeconomic uncertainty, even as risk assets rise. Inflation is stable, fostering a supportive environment for risky assets, according to Vincenzo Vetta, Chief Investment Officer at DWS. The economic cycle remains expansionary with no bubble evidence. Institutional investors are positioning for growth through 2026, indicating confidence in sustained economic momentum. United States policy decisions significantly impact global markets, affecting all asset classes. Rapid sentiment shifts can reverse losses, highlighting the importance of confidence. Predictability in policy, such as clarity on rate cuts, stabilizes equities, bonds, and currencies, while uncertainty breeds volatility. Asia's markets are particularly sensitive to global liquidity, underscoring the interconnectedness of modern capital markets.